So this is a work that Karan Gulati worked on with, and we looked at standard trope in India that Mauritius is a root of all evil, round tripping, and tax avoidance, and therefore needs to be shut down. Generally, there is a gravity model of trade, and then from that, there is now a gravity model of finance, which goes as follows. You first start trading in goods from some country. Then you start seeing that, yes, that country is good at manufacturing those goods, and then you start investing in that country. So the developed world first buys goods from China, figures out that China is good at making cars, and then GM starts setting up a plant in China. And therefore, the countries you trade with are the countries where you get your investment from. This is an established finding in literature, mostly holds throughout the system, but does not hold for India. Almost 50% of India's investments come from what is pejoratively called tax havens, what I would like to call them as entrepots, areas known for good business, ease of doing business, active rankings. So money comes to India directly, mostly from Mauritius, then from Singapore, then from Cyprus and UAE. Interestingly, US accounts for 16% of India's exports, but 6.73% of inflation of the investments. Netherlands accounts for 6.5% of the investments into India, but India has negligible trade with Netherlands. This is roughly where India gets its foreign investments from, and you can see up there is Mauritius, Singapore, Netherlands, Cyprus in them. And these are the countries where India imports from and exports to. Roughly again, there seems to be almost no relationship between the two. India's trade from the places from where it actually gets its investment from is again negligible. Mauritius has 0.0008% of its imports and exports only 0.384%, but accounts for 30% of the investment into India. And the prevailing explanation you might have heard in the newspapers that these have low or no taxes, and therefore that is the reason why investments come from Mauritius. We decided to look at another explanation for why India breaks the gravity model of finance and trade predictions. And what we did was we looked at the tax treaties. And of course, there was a lot of argument that the tax treaty between India and Mauritius was a very bad tax treaty. It allowed people to evade taxes. It was an evil tax evading tax treaty, which should be amended and changed. And in 2016, with great fanfare, India did change the treaty. And so we decided to look at, okay, how does the change affect? So we had to compare tax treaties, and we set up a system to compare tax treaties between India and its investor countries, between OECD countries, between themselves, which is roughly a free market tax treaty, between other competitors of India when it comes to investments, and between OECD countries and similar developing countries. So standard capital flows. OECD countries are the big capital exporters of the world. Roughly, there are two ways of looking at international taxation: source-based taxation and residence-based taxation. Source-based taxation is investor unfriendly. It exposes investors to excessive taxation. Residence-based taxation is investor friendly. So we roughly try to see, okay, whether investors are, whether these treaties are more source-based or more residence-based. So tax treaties contain a lot of provisions. They are very long. It contains things like if you go to do a PhD in a foreign country, whether your stipend will be taxed. If you go to play in Olympics, whether your Olympics gold medal will be taxed. We eliminated all those clauses and looked at 5 important clauses, which are the ways in which a foreign commercial investor can get return. So the investor can get capital gains. Permanent establishment exposes the foreign investor to domestic taxation rules. Therefore, it's very important. These are the rules which says when does a foreign investor become a domestic investor. The investor can get interest in form of loans. The investor can get dividend, and investor can get royalty for providing technology to the target or to somebody in India. And we scored tax treaties on a 1 to 5 scale based on this rating that 5 are the most tax-friendly clauses for these 5, and 1 is the most tax unfriendly. So 5 is residence-based and 1 is source-based. So we have this process of looking at each clause and then rating them. There is a methodology. You can go through it. I don't think it's interesting. So we looked at top 10 investors into a country as per OECD and UNCTAD statistics for the preceding 5 years, and then derived cumulative ranks for these investors and analyzed the top 3 investors along with the global treaties. So this is the number of treaties, clauses, and we have some overlap. So we created a peer group of India, which we call BCSST, which is Brazil, China, South Korea, South Africa, and Turkey. And we looked at OECD, of course. And we used 2 separate law students to grade the treaties, and they would then, we looked at the match. There was a small 5% difference between the 2. There we moved into put in, but more or less it was same. So we can be confident that our methodology was fairly robust. What do we observe? India is the most tax unfriendly treaty signer in our study group. So India's average is 3.05. India's competitors, our Brazil, China, South Africa, South Korea, Turkey is at 3.59. OECD between themselves are at 4.05. OECD also publishes a model convention, which is the starting point for tax treaty negotiations. So we just decided to score that also, and that comes at a score of 4.40. And roughly that is our say. So first of all, India is very unfriendly when it comes to foreign taxation, most unfriendly even compared to its peers. Then if we look at India's competitors, Brazil does worse than India in foreign taxation, but apart from that, almost all other countries across all measurement of the 5 methods of which you can affect business transactions, India does worse. So from permanent establishment, India is especially bad. Dividends, and many of these, India does much worse than every other competitor of India. Interestingly, India does much better in its tax treaties when it comes to the entrepôts, the so-called evil places from where money is routed. India's average tax treaty is 3.05 score. India's treaty score with Mauritius is 3.6. These are just 5 parameters, so the 0.5 is a substantial difference. Again, Netherlands is 3.5, Singapore is 3.4. It's not that these places are doing something evil. It seems India consciously goes or unconsciously goes and signs far friendlier treaties it signs with its normal trading partners like USA, UK, Germany, from where the trade model would have predicted financial flows. India signs some of the most unfriendly treaties with traditional capital exporters. India's average score is 3.05. The score with US is 2.1, one of the largest capital exporters in the world. United Kingdom, 2.6. Japan is a little better at 3.2. But roughly, India seems to actively fight against investments from the traditional investors of the world. Here is an example. If you come from United States and you do some business for 120 days in India, you will become a resident and therefore be exposed to all taxes in India. If you come from Mauritius, you can do the same business for 270 days before you become a resident in India for tax purposes. So we can do the clauses, and this is the examples of how the clauses are. The other interesting thing we found was India is the most inconsistent treaty signer. So we looked at the deviation of the treaty scores, and India's average deviation is much higher than Brazil, China, South Africa. So not only is India signs bad treaties, India also the most inconsistent position on tax treaty negotiation. In 2005, India did an amendment with Singapore and changed the treaty. And we see a very interesting thing happens. The moment the treaty gets changed, money starts flowing from Singapore more and less from Mauritius. So it doesn't seem that the nature of Singapore is what's determining the flow from Singapore. It seems it's the nature of the tax treaty that is doing this. So because of this whole thing, Mauritius was named as a evil place of tax avoidance, black marketeers. And so in 2016, with great grand fanfare, India changed its treaties. And we see the change actually reflected in our score. So we have before and after, and we have compared it with Singapore before and after because there was a tied-in clause with Singapore. But here's an interesting thing that happened. Mauritius seems to have negotiated some improvement in the interest payment rate. So the score with Mauritius before was 3, now it has become 4. So if you notice, capital gains is where Mauritius was seemed to have been given a very good deal because it had got 5. Now India negotiated the treaty and downgraded Mauritius to 4, and Singapore also got downgraded to 4. But in interest, Mauritius upgraded itself to from 3 to 4. So effectively, now you can design debt flows from Mauritius better than from Singapore. And this leads to this common phenomena that we get, and everybody in law firm circles knows how to structure this. So if there is a US investor and he wants to invest into India directly, he'll pay a 10% capital gains. But if that US investor opens a branch in Netherlands, sends the money to Netherlands and comes and invests into India, the US investor pays no tax. But if the US investor invests into South Korea, there is no question of capital gains tax because that's a standard OECD model treaty. And all this is doing is generating cars and income for lawyers in Netherlands who have to create a shell company. Now, this has interesting implications, which is not our work. There's a separate work on this, and this is quite interesting. So you can think about factors of production as mobile and immobile. Capital and technology are mobile factors of protection. You can just move IP anywhere in the world over an email. Money flows freely all over the world. But there are immobile factors like labor and land. It's difficult to move people. Of course, you can't move land. Now, an international investor is interested in a post-tax return. So let's say you're an US investor, you want to invest in South Africa and you want to invest in India. You care about what is the money you will get after South Africa and India have taken their share of the tax. And if the rate is South Africa is higher, then of course you will go to South Africa. If the rate in India is, if the tax rate in India is higher, then you will only invest in India if that extra tax rate is compensated. Now, since capital and technology are mobile, factor and labor are the only thing, the land and labor are the only ones which have to do this. So if capital and technology, capital is dividend, interest, capital gains, taxation, and technology is the royalty payments. If those will be higher in India, then land and labor will have to be compensated less so that the return from India is the same as the return from South Korea. Now, this means that Indian laborers and Indian landowners will have to get less money from a foreign investor so that the foreign investor's net tax return from India is the same as from its competitor places like Brazil, China, South Africa. But this leads to an interesting problem. Capital and technology under the treaty is taxed at 15%, while the laborer who sits in India will pay around 30% income tax plus 18% GST. So the total tax collection because of this may actually be lower for India by signing an aggressive tax treaty which allows it to tax. Our solution to this is, policy solution is, India should just think about moving to an bad. It's long time it will take to get it solved. We need to solve that on time. But till then, if we move to a residence-based model where we don't tax foreign investors, we can give them protection to attract more investment. And more investment may be actually revenue positive for the country because all the salaries and will be paid in India will generate income tax, salary income tax, which is very difficult to evade. It will generate GST tax of consumption. The properties that these foreign investors will buy will generate tax and income for Indian landowners also. That's it. Thank you.
Thanks, Shubho, and good afternoon, all of you. I'm a late sort of decision on discussion for this paper. I'm not a tax guy, I'm not a statistics guy, but I have a reasonable understanding of public policy and government. So a lot of my inputs will go towards answering what I think are some questions that this paper throws up. I guess some more statistically inclined people will look at this methodology because in terms of its robustness, are these the right measures, etc. Clearly, I don't know enough, and I think it will be very useful if somebody can look at that. I'm sure Karan and Shubho know this, but if somebody else also validates this. Clearly, very quick summary, I don't need to do this in detail. The perception that Mauritius is a tax haven and India's tax treaties with such jurisdictions with loopholes is, in a sense, the cause of the large volumes of investment flows is something that this paper challenges and says that it is not a particularly investor-friendly treaty, but it's relatively more investor-friendly vis-a-vis treaties that we have signed with other countries. And essentially it argues that Indian tax treaties suffer from three significant sort of problems. Most source-based taxation compared to other jurisdictions, which is most investor unfriendly. Two, it is inconsistent vis-a-vis countries. Countries we expect to have a natural capital flow relationship with, what they call the gravity theory, are not countries which seem to have the advantage that one would expect, if at all there is an advantage that needs to be given vis-a-vis the quote-unquote tax havens. And within the same treaty, there is inconsistency when it comes to different forms of returns. And the conclusions are what Shubho said in the last slide. The treaties are not equally or uniformly unfriendly. That's an interesting point. Two, we need to be comparing with not Indian treaties across countries, but countries which are doing treaties with countries from which we expect investments, and hence a suggestion to sort of reconsider the source-based taxation. Now, the methodology of the paper, I think I can skip these 3 slides. I found the paper very interesting. I have dealt with this problem in some form or the other, not from the tax side, but from the FDI side for a while. And I think clearly it's a very refreshing approach. I think this comparison and comparing DTAs across space and over time of Indian DTAs, I think is an excellent, I found the methodology interesting intuitively, but I repeat what I said earlier, namely, experts in statistics kindly take a look at it. Let me come to the points for discussion and the questions that I have. Indian income tax, independently of foreign taxation, has historically and always been rooted in maximizing the advantage of both source and residence. So if you speak to the income tax hierarchy, they talk about quote unquote maximizing revenue. So it is like a lot of irreconciliables, it is this and that. Source-based is clearly the dominant form, but they don't, at least the income tax practitioners don't say we are source or residence. Yes, we are clearly dominantly source, but we are on to maximizing revenue. Two, this therefore informs our DTAAs also. The basic feature of Indian taxation spills over into DTAAs. And the question is, if as you say, source-based taxation is quote unquote not only inimical for foreign direct investment flows, but also for revenue flows, why do we persist with it? Because I don't think income tax irrationality, foreign direct investment irrationality can be the entire explanation. An entire bunch of professionals can't be so irrational. So are there, I'm sort of going in the reverse order. Looking at the result, it looks perverse. So what are the questions that I have for the authors? Are we the only country which has source-based taxation? The answer is no. There is a large number of countries, and not merely emerging market countries, that have source-based taxation. So why do countries continue with source-based taxation if residence-based taxation was such a clear path to heaven. To heaven, not haven. Two, does not every source-based taxation country protect the right to tax interest, dividend, and royalty? Again, the answer seems to be yes, fairly large numbers of them. And in that sense, again, if you speak to the Indian tax practitioners, the discrimination against capital exporting countries is therefore, I think, inbuilt in this design. So we need to question the rationality of the design from a larger point of view, because if you take that design as a given, this consequence is a natural sort of result. Three, what about the recent developments? The entire base erosion, profit sharing related efforts, recent OECD efforts. The clear policy thrust seems to be not to allow double non-taxation. And that is something which comes out in all the OECD literature. If the policy to not allow double non-taxation is accepted, and regimes like Singapore and UAE persist with what they have, a bulk of the world will move to source-based taxation. So we are going to be sort of questioning the very basic premise you start with post the recent developments, if I've understood the BEPS-related developments right. Four, if countries, and mostly EMEs in this category, migrate to residence-based taxation, will it address the problem of treaty shopping based on tax arbitrage? The answer doesn't appear to be an unambiguous yes. So I think it's something, at least I have not been able to figure out. You need to think about it. Is it, and these are my two public policy related questions, getting all of these coordinatedly right. There is a tax policy issue, there is a FEMA issue, there is a whole bunch of regulatory issues, all to be done by very different departments, different agencies, some of which are statutory regulatory agencies, which don't agree to come and discuss this with government. Is this whole question, this interplay of regulation, taxation, and FDI, some of which regulatory, some of which sovereign roles, finally a very serious state capacity issue? Because the countries that seem to be getting it right are countries that are also very high on any measure of state capacity, certainly on the economic regulatory side. So is this a state capacity issue, and is this an issue? Oh, I think my slide 6 is missing. The question that I had, which I added, is, do we know the breakdown of the monies that are coming from the tax havens? My clear anecdotal sense, and I've sat in on more meetings on this subject with very senior politicos than most people in this room, there is something about the breakdown of money coming from these tax havens which makes me think this is not about foreign taxation at all. This may be all about how do we deal with our money that has gone out. Our money that has gone out for a whole variety of reasons, of FEMA, of, the reasons may be varied, stupid capital controls, etc., etc. But my suspicion is, and it's not going to be easy to get data on this, if we can get breakdown of data of monies that are coming from tax havens and find some method of figuring out what is Indian origin money coming back to India, I think we may have a lot of the answers. Now, this is clearly not an answer which flows out of data analysis. This is answer that's coming to me out of 8-10 years of discussions in policy rooms where, if you recall, pre-2014, the strongest voice against P notes have now become the strongest supporters of P notes. Every action on P notes is the reverse of what was announced pre-2014. So I think there is something about the political economy of this money which may finally be the very non-scientific answer to a very detailed scientific paper. Thanks.
Thanks a lot, Krishnan. So before we open it up to the floor, Shubho, would you like to respond to some of Krishnan's comments?
On your last point, if we, and Ajay, correct me if you, because this is a macro question, I don't think there is much of that so-called round-tripping money in this. The magnitude of capital flows in India is so large in the last few years. If we assume that a lot of that money was, say, stolen in the 70s, then I would say that 70s our GDP was so small that that number has to be thought through in one way. That's the one point that, in order of magnitude, I don't think there was so much capital surplus outside India. And even if it was, the best thing that can happen to money that was illegally taken out of India, so-called illegally, is it comes back to India. The world has a large number of investment choices, and if you have successfully taken money out in the 70s and 80s, you can buy Japanese companies, you can buy Chinese companies. The best thing that can happen is it comes back. And then you start investigating for people who are taking it out illegally and start catching them. It's the way to think about which side of the border control you want to do on this. I would argue that the best way to do is to let the money come in and then start tracking whoever has round-tripped. In the way in, stopping is a bad idea, I think. It doesn't serve any of the purposes. You don't catch them because the transaction of the money doesn't come back to you. If you raise the barrier, if you make it easy, let them come in, then you do your investigations, it would be much easier on that.
No, in which case I didn't convey this, I think, adequately correctly. It is not a one-shot 1970s money that is coming back. Round tripping by definition is continuous flow. I want to control my company here. I don't want to control it formally through my Indian entities. So there is a continuous flow of money. All we need to do, unfortunately you can't do RTI on this, start looking at the FIU reports. The volumes of money that are going out and coming back are not small. And at one point in time, 70s and 80s was one kind of money. The going out and coming back is now a continuous cycle for a variety of reasons. So, but a lot of that is speculative. So I don't think I will sort of put my money on it. And two, who is interested in controlling it? I'm talking about lack of interest in controlling it and explaining the Mauritius, Singapore, UAE treaty. I don't want to control it. And therefore, when there is pressure on me to rewrite the Mauritius treaty, I formally rewrite it, actually making it easier.
One more thing. Yeah. One more thing, a lot of the developing countries quietly, without making much fanfare of it, went and signed tax-friendly treaties. So if you look at communist China, right before or around the time it joined WTO, it went and improved its score fundamentally a lot better with US, with Germany, with Japan, with whom it actually has a lot of political troubles. So a lot of developing countries publicly keep on saying things like source-based taxation we want to do, but quietly join OECD treaties. On one more point about state capacity, there is a free lunch here which is just sign the OECD treaty. Israel did this, South Korea did this. The moment they joined OECD, there is a packet of laws that comes in. It solves a large number of these problems, the coordination between capital control, securities regulation. We really don't have to think about it too much. Or you can do one by one, just let's forget about the SEBI regulation, FPI regulation, let's get the treaty signed. And it is very easy, because if you go to any OECD member country and say, I want to sign an OECD treaty, you will get it. We were surprised, by the way, we thought the OECD model treaty will be the most, would be the highest score. We actually had to downgrade it to 4.4 because we found some OECD treaty countries and developing countries sign clauses which are more residence friendly than even the OECD model treaty, which is considered the most aggressive neoliberal tax investor friendly treaty model in that. So the world is changing quietly on the side. Countries don't advertise it. And I think sometimes the countries ask US or Germany that we are signing it, but don't make a big event out of it because we have to tell our local population that we are not doing it.
So wait, so there's Surya, there's Behram, no, there's Surya, there's Behram, and now there's Barrows, who promised to ask a question.
Anyway, I'm audible. So thanks, Shubho. I think, and thanks, Dr. K.P. Krishnan. The way you put across your points just doesn't, you're being too modest when you said you're not a tax person in the way you said this question. It's fantastic the way you communicated. On the methodology, Shubho, I would say just looking at tax rates or dividend rates or royalty rates will not give you the full picture. If you look at, I know it will cause an upset the whole scheme, but the Mauritius example, when your score did not change much even after it was revised, except for that interest portion. The big change is the LOB clause, what is known as the limitation of benefits clause. That really changed the way Mauritius is viewed. So I would strongly urge you to look at anti-abuse provisions in all of these treaties in your, the way you have thought about this structure. And tax haven is a global focus. So you can't just say evil money laundering locations. This is a global focus across governments. And rightly, Dr. K.P. Krishnan pointed about OECD. You keep talking about as if OECD is a gold standard to meet. The criticisms of OECD itself are fairly, widespread. All of these DTAs that we aspire to, that you said we should aspire towards, are asymmetric when they were engaged with, when they were entered into. If you say, you pointed about India-US treaty. The equation at that point of time was not favorable for us to negotiate these terms, which is why Mauritius came about as a vehicle for people to, divert these funds. So there is a political economy of the point at which the agreement was entered into, which you will need to consider, or rather, which you need to be mindful of when you draw your conclusions. Now, and that leads to the talk about how the newer efforts of BEPS or the UN model, which strongly is a counter force to the OECD model, does protect the interests of resource-rich countries. As finance mobility grows, the interests of resource-rich countries are coming into focus. Low taxation is not always desirable. You need to take into account the welfare activities of states for them to protect the resources, whether they are natural resources in terms of minerals or people or environment. So therefore, OECD as a gold standard and further efforts, you will need to factor into your solutioning. And the last point is on how multilateral agreements are the way ahead. It's not OECD. OECD is driving it, but it has diluted its positions on many things. And India, being seen as an outlier in this space, is being considered to be the standard setting country. For example, the digital equalization levy that was imposed recently, 2016, I think. Many countries are now following it. So for us to protect resources of countries, taxation is an instrument. And India is seen to be the front runner in setting the agenda for other countries in how they should respond to technology, as how Dr. K.P. Krishnan said, the double non-taxation of technology companies and capital. So some work still to be done on this paper.
Shubho, if I may, can we just take the questions from the floor? Because if we should run out of time, which is very, very, very likely, at least we will have the questions. Behram, Barrows, and now Ajay puts up his hand.
Yeah, thanks a lot, Susan. Just three quick things. One is Dr. Krishnan will check if my memory is right, but I think in the UK Sena committee also we had the tax people around the table, and though it was focused primarily on FDI, we did try to push a lot of the points we talked about today. So, am I right in my recollection that some of it may also be inertia, that they were pretty fixated, they were not open to the ideas we were suggesting, is what I remembered. So that may be one of it. The second one is to the point you were making today, is that the way the world is moving and the capacity question, it may be the right time for us, whether it's OECD, whether it's a renegotiation because our leverage with the US is better, but it kind of fits into the electricity arguments we heard that our system is broke. So whether we have to move to renewables or not, this is the ideal time. The system has been broke since 93, at least, maybe even earlier than that. So we have to actually fix our system and make it renewable. So it's a great time to do it. Similarly, for taxation, it may be a great time because the world is very focused on it. So it's the right time to fix the problem totally. And the last thing I wanted to ask you, which I've always wondered, is why was it Mauritius? I mean, I understand that you may not have had the leverage with the others, but why did we choose Mauritius? I never got that.
Nice beaches.
It's a different. If I can answer that, from a literature that I read, so Indian companies wanted to trade with Africa.
Africa.
So Mauritius was taken as
Nishit
the.
Desai headed that.
So this is what I.
Do this
even
after.
Ajit should
Let's
tell
finish.
that. It was actually outbound,
Yeah, I do
which
that.
was why Mauritius was
Outbound.
used.
Barros, have you asked your question?
No.
Barros has been waiting for 12 years for a tax to be covered in the conference. No, but please do ask your question. You need to come to the front.
It was a very good paper, and I think very well. I mean, the way it was discussed was something very different from how we and tax look at treaties. So it was good in that sense. But I think there are 2-3 points to it, and we strictly believe that source-based taxation is something which everyone is now looking at. And Mr. Krishnan did mention about it. There's nothing wrong in it because you get a tax credit in your country of residence. So if that person is actually a resident of a country, he should not worry of paying tax in the source country because he should get a credit for it. The question then comes in is where they don't get the credit, there's this sort of gap or a leakage. But generally, why should we worry from India? Because we have the supply here, we have the population here, the market is in India, it should be source-based. So I think that should be the premise for it. Sorry. And secondly, the way they mentioned, normally treaty negotiations are not only done from a perspective that where investment is coming into India. Sometimes when treaties are negotiated, it's mainly like they mentioned, Mauritius was more to make investments outside of India. Singapore, for that matter, also was earlier looked at from when you're making investments globally. Netherlands, for one, was generally there for making investments in the US. So there was a lot of negotiations which are done, not from perspective of coming into India, but going out from India. And US, if you look at it, when they negotiate treaties, it's basically based on their standard. They are looking at it from their standard, say it should be at this rate of tax. And it's not from a perspective whether you're getting benefit or not getting benefit. So I think those aspects have to be considered. I don't know whether you've looked at MLI. OECD MLI has come in, multilateral instruments, where they have actually now got so many countries to sign a multilateral instrument where they negotiate treaties at a large scale. And then each country has gone and implemented it, notified it, various clauses. So they've tried to standardize treaties across globe. So I think you could not to look at that also. And of course, we have limitation benefit clauses, but the Mauritius LOB clause is a little different from Singapore.
Yep.
And Mauritius LOB clause is only for that restricted part of it. But you do have a principal purpose test now. So you need to look at all of that to see, whether. And the interest clause on Mauritius, if you look at it, earlier it was as per the normal rate of tax. But most of the debt which used to come from Mauritius used to be from a bank. So you could have a bank in Mauritius who was putting in debt in bonds in India, which was a 0 rate of tax. So from the 0 rate of tax, they have now gone to 7.5, as compared to a Singapore, which is 10 or 15. So if you go to see, it's not worse off. From a 0 rate, they've gone to 7.5. So in that case, it's not 3 to 4. It is still 3 to 2 maybe. So in that case, it's not in that manner that you have to look at it.
So a quick response to some of them. Goldman Sachs will tell you today it's a bank, tomorrow it will say it's an NBFC. Goldman Sachs will tell you whatever you want to hear it to be. So if the bank rate is low, then Goldman Sachs will incorporate a bank. If the rate for petrol companies is low, Goldman Sachs will incorporate a petroleum refinery and give you the loan.
And interest rates generally now, domestic rate itself is 5%. So people don't look at treaty for interest.
Maybe.
Because
The
it's
other
5 in the domestic law.
The other point of this source-based get a tax credit is really bad because the largest sources of capital today are not taxable. So California Pension Fund is one of the largest pools of capital, and California Pension Fund is completely immune from taxation. Harvard Endowment, which for $50 billion is, so Harvard Endowment will look at India and will look at South Africa and look at South Korea and say, my return from India is 7% less because you can give me a tax credit. US doesn't tax me anyways. So that whole tax credit system is a really bad system. In the same way, if Tirupati Devasthanam board was investing somewhere outside, what will it do? So it cuts both ways for us. And that tax credit system is a senseless, bad system because there are multiple layers. Tax credits don't flow through the layers. It just doesn't work at all. Everybody in the world has abandoned it. On BEPS, I have very contrarian views and we can discuss this afterwards. Thank you.
So wherever it's not tax credit, then at least in one country they should pay tax.
No,
So that
Correct.
no,
Yeah, so let them
This is probably why we never had a tax bill. It just cuts too close to home, and everyone has a point of view. Ajay, I hope that you asked your question.
no.
Well, I have only one sentence to offer.
Please offer it.
Yeah, so I want to say that this is the subject of the fundamental economics of tax policy. And I want to say that exactly as we all understood that customs and excise are wrong taxes in a world of globalization, and you should move to the VAT and the VAT only with zero rating of exports and VAT on imports. It is exactly like that with residence-based taxation and source-based taxation. In a world of globalization, source-based taxation is completely wrong. It is exactly as bad as customs and excise. So just like on the indirect tax side, we move the whole world to VAT. Like that on capital flows, we have to move the whole world to residence-based taxation.
You do realize that was more than one sentence. All right. So thank you all very much. Shubho, thank you for a very thought-provoking paper and for fulfilling Burroughs' dream of 12 years. And thank you, Krishnan, for a very, I figured that it would be a very unique perspective that you would bring as a discussant, and I hope that it was okay. And I thought it was amazing. So with this, I call this session to a close.